Hey, hi everyone. My name is CA Vijay Kedia. Welcome to my channel. In today's video, we are going to talk about a topic which is very close to everyone's heart, which is buying your first house. And YouTube is telling me more than 60% of my audience is young, between 25 to 35 years of age. And I understand at this age, there is a lot of family pressure and peer pressure that you should buy your first house as soon as possible. And when you see those big hoardings, advertisements related to new launches, that also gives a kind of a FOMO, fear of missing out, that if you don't buy it now, you might never get this kind of opportunity again. So, in today's video, I'm going to tell you why it's important to avoid that unnecessary pressure or FOMO when it comes to buying your first house, and how you can build a tax free corpus to buy your first house, right? Because no one likes to pay taxes, right? And so the thing is, if you're buying your house for like tax benefit or for some other similar reasons, then this is not going to work, right? Because slowly government is moving towards a new regime where all the deductions will go away, and then you'll have to eventually move to the new regimes. And in this budget, government has also removed the indexation benefit which was available on your house while selling, and so that you could reduce your tax liability on the capital gain you are getting. But that benefit is also removed now, right? And then government is going to push you towards new tax regime where you can't claim any deduction for housing loans and things like that. So uh, the point here is how to change your strategy, financial strategy, to keep up with this kind of changes so that you can be ahead in this game, right? So I request you to stay till end of this video, because this 10-15 minutes are going to be very important towards your financial journey. So with that, let's start. To explain this, let's start with an example. Right? Say you are planning to buy a house of 1.1 crore. So 1 crore might be the base cost of the house, and remaining 10 lakhs for registration, stamp duty, and other expenses. And you are planning to give a down payment of 20 lakhs, and rest 90 lakhs you are going to take a loan on which the EMI is going to be 90,000 per month for 15 years with current rate of interest. And the assumption which I have taken on returns is property 8% based on last 20 years data. So you can expect your property price to double in 9 years following the 72 rule. And uh, and I have also considered the index fund for our calculation with a CAGR of 14%. Because if you look at the index fund return for last 20 years, that's 15% plus. So I've considered 14% here. So with that, now in the first year, instead of taking that loan, you invest that 20 lakhs which you are planning to give as down payment into that index fund, and this is the amount. This is the amount you will get at the end of 15 years with 14% CAGR. Similarly, for the monthly payments, which was 90,000 for your loan, uh, instead of that, if you stay on rent and you pay 30,000 rent, which is like 3.6 lakhs per annum, which is almost 3.5% of your property cost. So, because the property rentals are between 3 to 4%, and I have considered 3.5% here. So, and then remaining amount you're going to invest in monthly SIPs in the same index fund, right? So that amount, if you invest 60,000, you invest monthly into index fund. Year-end amount will be this along with the return, and that amount at the end of year 15. So if you on this amount, if we consider 14 years of compounding, so this amount will become this, right? 14 lakhs plus. So similarly, I have done this calculation for subsequent years because I have also considered the increase in rent. So if the property prices are going to increase by 8% every year, then the rent should also increase in the same proportion. So I've increased that rent amount by 8% every year. And so and then you are investing the remaining amount in SIP. So next year, your rent is increasing by 2,400, and your monthly SIP is going to decrease by 2,400, right? So this is the year end amount for in the second year for your second year SIP, and that amount at the end of year 15 is going to be this, because this amount will also compound for next 13 years, right? So similarly, I have done that calculation for 15 years. And if you see in year 15, your rent amount is almost closer to the EMI amount which you're planning to pay. That's true. Even with that, if you keep using this strategy, your value of your investments, which you did through SIP and the initial lump sum for that down payment amount, the total amount is coming close to 4 crores. And if you see the value of your house, the cost of your house in 15 years at 8% CAGR is coming 3.5 crores. Now you'll say the difference is less, but there are other things also which you need to consider. First of all, if you are selling that house in year 15, that's a 15-year-old house, right? So you will not get 3.5 crores for that, right? So if the current cost is 3.5 crores, you will get 20-30% less than that current market price, so probably you'll get just 2.5 crores. If you're planning to sell that house, then your cost will be considered as 1.1 crore if you would have taken loans, and your long-term capital gain will be around 1.4 crores. And then at the rate of 12.5%, you would have paid 17.5 lakhs as taxes. But in this case, the amount which is accumulated, almost 4 crores, if you use that money to buy a house, that entire capital gain is exempt under section 54F. So this is very important, right? So whatever gain you had in your SIP and investments, if you are using that to buy your house, so out of say 4 crores, you are using 3.5 crores to buy your house, you can use it, and that's completely tax free. You're not going to pay any tax on that 3.5 crores, right? And it also gives you time. So if you are still looking for house and it's taking some time, it gives you time to buy a house in next 2 years, or construct a house in next 3 years of redeeming your investment. So you have time to look for a house and buy your house with that money, right? And until then, you just need to keep that money in a capital gain account scheme, which can be opened with any public sector banks, to claim that exemption. And when you're ready, just use that money to buy your house, right? So what we see here is, if you buy a house with loan, and then if you're planning to sell after say 15 years, you are paying huge taxes, right? And also, your since your house is not new, you're not getting the market price at that time. And then if you consider that, in this case, your net receipt, if you're selling that house after taxes, it's coming around to 2.32 crores, versus this, where you have 4 crores in hand, right? You can buy a house, and if you're buying for a lesser cost, then remaining money is with you to be used for your financial needs. And on that remaining amount, if you withdraw that, you need to pay 12.5% of tax, the amount which you're not using to buy house. But that's okay, right? Because the major amount which you're using to buy your house is still exempt. So hope this example made things clearer for you. That so in this video you saw how you can build a tax-free corpus to buy your house without any debt burden. Apart from buying a house, you are also getting some extra corpus which you can use to meet your future financial needs. And also, if you're selling that house in future, there also your capital gain will be lesser, because your cost of acquisition would be higher compared to buying a house upfront. And then there are also non-financial aspects which you need to consider, because what I believe in initial stages of your career, you should be as mobile as possible. So if you buy a house, you get kind of tied down to a location. So you should try to avoid that. And then in your 40s, when you have decided where do you want to live the rest of your life, then you'll be in better position to decide the location of the house, and then At that time, you can buy your house upfront, and it's a new house. And many people argue that buying a house is a emotional decision. And my counter argument is mixing emotion with investment can be injurious to your wealth. If you want to buy something out of emotion, buy some small value item, not house, right? So it's which takes the biggest chunk of your money. Else it's very difficult to come out of this so-called middle class trap, right? So I'll make a separate video on that. But until then, hope found this video useful. Please share with your friends and colleagues, and hit the like button if you like this video, and please subscribe if you're not done already, and I'll see you in the next video. Thank you.